Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and this is just 2 days after the budget when we've seen so many changes in mutual fund taxation rules as well, be it the long-term capital gains that has been hiked to 12.5%, the limit being hiked to 1.25 lakh. The short-term capital gains, they have been increased to 20%. So there's a lot more. The specified mutual fund definition has been changed. So let's try and understand what would these tax changes and the definition changes mean for your investments. We have joining us today Mahendra Jajoo, the Chief Investment Officer, Fixed Income at Mirrae Asset Investment Managers, and Ashish Shanker, Managing Director and Chief Executive Officer at Motilal Oswal Private Wealth. Gentlemen, good afternoon. Thank you so much for joining us. And there have been so many amendments. It's very difficult to actually boil it down comprehensively. So we have both of you on the show today. Ashish, let me start with you. First is, of course, that change in the long-term capital gains rate changed from 10% to 12.5%. We've seen a big surge in SIPs, investment in equity funds. Will this increase prove detrimental for investors? What has the general viewpoint be here?
Hi, Sonal. Happy to speak to your viewers. The hike in capital gains is a small one. We've gone from 10 to 12.5. Given the potential returns from equities, I guess it'll not matter much, because if you look at some of the other asset classes, the differential return is still pretty significant in terms of the rate of compounding that we have seen in equities over the longer term. And even in the future, I do believe, given the kind of growth path that is ahead of us, I think investors will take this tax hike in their stride. I don't see any reason for, let's say, lack of flows or lack of allocations just because of the tax change that has happened.
Okay, all right. So that's good to know. It doesn't really change how the investors, or at least the long-term investors, go about investing in mutual funds. Mahendra, welcome to the show. I wanted to understand, because now the definition of specified mutual funds, that has been changed. Wanted to understand, what does it indicate? How would that change things for the industry and the investors? And is this something industry wanted for a long period of time? Is this something that they have liked as a change?
I mean, as far as the specified mutual funds are concerned, as far as the debt side is concerned, there is no change, because the debt funds were anyway being taxed at the marginal rate. The investments made on or before 1st April 23, those will continue to be treated as the long-term capital assets, and therefore, while you will not have the indexation benefit, you will still have the long-term tax rate applicable. Insofar as the definition of the specified mutual fund is concerned, it has been simplified, and now the definition says that the mutual funds which have 65% or more invested in debt and money market instruments. So therefore, you have the entire category of the gold ETFs, etc., which have now been taken out. So to that extent, there is a refinement. But as far as I understand, as far as the debt funds are concerned, there isn't anything incrementally changing in terms of the taxation treatment, and therefore it remains the status quo.
Oh, okay. Because the indication was that there have been some changes in the debt taxation bit as well. But I'll come to you in just a bit on that, Mahendra. Let me come to you, Ashish. Is this something that the industry is liking, the change in the definition of specified mutual funds?
Yeah, so Sonal, whilst the increase in the rate of capital gains is a slight negative, however, I think I welcome the move to simplify the tax slabs. So now investors have to just remember two things, right? There is a 12-month capital gains incidence, and there is a 24-month capital gains incidence. So as Jajoo said, now the definition of debt funds is very clear, right? Any fund which is investing more than 65% in debt instruments is classified as a debt fund, which will go under marginal taxation or slab rate. All other funds will have a 2-year window. That is, when I say other funds, I'm talking about non-equity. We'll have a 2-year window to get the long-term capital gains benefit. And the slab is basically now got homogenized to 12.5%. So actually, from an asset allocation perspective, it is a very positive move, because now gold funds, the international fund of funds, the hybrid funds, depending on how much they allocate into equity and non-equity, they will be subject to long-term capital gains after 24 months, and they will come down to 12.5%. So actually, from an asset allocation point of view, this is a very, very welcome change, and it becomes simpler. Of course, the only change is for earlier investors, right? People who invested before debt funds became fully taxable. Now, whenever they redeem after 2 years of their original investment date, they will now be taxed at 12 and a half. The earlier understanding was they would have got indexation and taxed at 20%. So that's a change for the old investors.
Okay, all right. That is what, yes, exactly. That's what I wanted to understand. So if you've invested before 1st April 2023 and redeemed on or after 23rd July 2024, the LTCG will be at the rate of 12.5%. Is my understanding correct?
Absolutely.
Okay. All right. Gentlemen, we have a lot lined up on the show for you and we need to ask you a lot more questions, but we have to slip into a quick commercial break. On the other side, we'll continue our discussion with Mahendra Jajoo and Ashish Shanker on mutual fund taxation in the budget. Stay tuned. Welcome back. You're still tuned into MF Corner. We still have with us Mahendra Jajoo of Mirrae Asset Management and Ashish Shanker of Motilal Oswal Private Wealth. Mahendra, let me come to you because, you know, debt side, it has seen those changes last year when the indexation benefit was removed. And now with the changes in the definition of specified mutual funds and what we just discussed on investments redeemed after 23rd July 2024. So those are the things which are confusing the investors a little bit. So just wanted clarity on that. How does it now compare with, say, a fixed deposit? Is it still the level playing field? How can an investor compare the FD taxation versus a debt mutual fund taxation?
Yeah, so in terms of the applicable tax rate, which is the same for the FD and for the debt mutual funds, which is the MMR, but there are finer aspects. For example, if someone is investing in FD, then he will have to pay tax on accrual basis on the deposits interest, irrespective of whether the deposit is matured or not. But the big difference with and the huge advantage which the debt mutual funds still have compared to the FDs is that if someone is a long-term investor, you will not pay any tax in the debt mutual fund until you redeem. And when you redeem, you can time in terms of your tax position depending on year to year. So one big difference is that the tax treatment in case of debt mutual fund is back-ended at the time of redemption. So if somebody invests for 5 years, he gets a 5-year compounding advantage over and above the deferral of the tax. In FD, every quarter or at least yearly, you will have to pay interest. The second difference between FD and the debt mutual funds is that FD will give him a fixed rate of return, which is determined by the bank, whereas the debt mutual funds provide return which are linked to the market. Now, when we talk about inflation hedging, the simplest concept where this inflation hedging applies is when you invest in an asset which gives you market-related returns. So, of all the debt options which are available today, debt mutual funds are the only option which gives the investor a market-related return and gives him an array of choice in terms of the short-term funds, long-term funds, duration funds, credit funds, etc. So I think while on the front of the taxation, just the rate is same, but the, as I said, mutual funds have an advantage. But there are many, many more other finer aspects where the debt mutual funds, in my view, score highly over the bank fixed deposits or other comparable debt options. So I think so far the investing in debt mutual fund was largely guided by the tax advantage, but I think going forward, the investors will also begin to appreciate the other advantages, and therefore I think the debt mutual funds will come up on their own without the crutches of the tax advantage.
Okay, all right. That is very helpful, Mahendra, because as I said, it was the before 1st April 2023, the redemption after 23rd July 2024, which was a little confusing. And how does it compare with fixed deposits right now? Ashish, let me come to you. Hybrid mutual funds, multi-asset allocation funds, they saw a lot of traction post the debt taxation changes, and generally because that provides a larger asset class in terms of investments. Is there anything that changes now for the investors in this category?
So, Sonal, at the margin, it becomes even more attractive because the definition is very clear now. So, you could have less than 65% in debt and have a hybrid fund and avail of the 12.5% taxation after 2 years. So, actually, these funds become even more attractive. I believe that a lot of investors will move some part of their debt allocations to multi-asset kind of funds, because they can give you an inflation hedge, because they can have allocation to gold, they can have they can have some allocation to equity and still avail long-term capital gains after 2 years. So these funds will become very, very pivotal in creating a portfolio. As far as equity is concerned, I think it continues to be an attractive asset class because of the compounding it generates. You can also now have standalone gold funds. Earlier, gold funds, the understanding was that it will be taxed at MMR. Now, with this change in the specified mutual fund definition, gold funds will also be taxed at long-term capital gains after 2 years at 12.5%. So earlier, sovereign gold bond was the only instrument which is to give you a tax benefit. Now you can allocate that money in gold funds as well. And for new investors coming in, the price of gold is lower, because what they've also done is they've reduced the excise duty from 18 to 9, although there is a one-time hit for existing investors. But for investors who come in now, there is a benefit.
Oh, okay. There was a separate question on gold altogether for me, for you, Ashish, which I would have asked you after this segment. But we'll, of course, take a deep dive into that in just a bit. Mahendra, coming in on to you. For specified mutual funds, was this an ask for a long time? And is there something which hasn't come in the budget, which the industry was expecting from the debt side at least?
So industry was hoping that there is some sort of, advantage or, some sort of headroom created for the, debt funds. As Ashish just now mentioned, that now even the gold fund or other funds with different combinations other than debt will have the long-term capital gain advantage. So in the economic survey, there was a detailed description on how the quick financialization of the savings can lead to higher risk, etc. Especially after the economic survey, there was some hope that some sort of preference will be given to debt funds to enable the platform for the huge investments that is required in the infrastructure sector. But at this point, there does not seem to be any reprieve for the debt fund investor. However, my view at the same time also is that this is just one of the taxation angle. But then even when the interest rates were negative, the fixed deposits or the deposit base of the banks continued to grow. So I believe that there is a separate class of investors who look at pure debt option within their portfolio. Therefore, the debt has to compete not with the other sub-segments of the mutual fund industry, which is the equity fund or hybrid funds, but the debt has to create its space out of those people who are keeping 92% of the financial savings of the country into pure debt products. So I think that is where the growth for the debt segment has to come, not by trying to prove or suggest that debt returns or debt funds by themselves can be superior to the same competing products within the mutual fund space. So that's where I think the industry will now have to focus and create headroom for growth on the debt side.
Okay, we get that point. Gentlemen, we have to slip into another quick commercial break. On the other side, we have a lot more questions with you, so stay tuned. We'll continue our discussion with Mahendra Jajoo and Ashish Shanker. Stay tuned. Welcome back. You're still tuned into MF Corner. We're discussing everything that would impact you because of the changes in budget this time around. And we have our experts back with us, Mahendra Jajoo and Ashish Shanker, on the new mutual fund taxation rules. Ashish, coming to you, because we've discussed about gold ETFs and gold funds. I just wanted to ask you in greater detail here, how would things change for gold ETFs, international funds, fund of funds, because of the change in specified mutual funds? And now are these gold funds at par with, say, sovereign gold bonds here?
Yeah, so let me just simplify this for your viewers, Sonal. Now there are three categories of funds, right? There are funds which invest more than 65% in equities. So they get classified as equity funds. So after a year, you have 12.5% taxation. And before a year, you are taxed at 20%, which is short-term capital gains. The second type of fund are funds which are investing less than 65 in debt, right? So those become less than 65% in debt and not more than 65% in equities. Those become hybrid funds. Now, those you have to wait for 2 years for long-term capital gains benefit, and the long-term capital gains benefit is the same as equity, which is 12.5%, and before that it is marginal rate. So what happens is for gold funds, earlier they were being taxed at MMR after the tax changes that they did in 2023. So as a result, the sovereign gold bond product became very, very attractive because there is no taxation if you hold till maturity. Only the interest portion is taxed there. Now, with this change, you can invest in a gold fund and you are eligible for a long-term capital gain benefit after 2 years. And that taxation is at 12.5%. So it's easier for a person to asset allocate. As far as comparison to sovereign gold bond is concerned, sovereign gold bond from a taxation and effective return point of view will still be more attractive. But remember that sovereign gold bonds have a lock-in, whereas a gold fund doesn't have any lock-in. You can redeem the gold fund whenever you want, right? And if you wait for more than 2 years, then it becomes taxable at the long-term rate of 12.5%. Hope that part is clear. Coming to FOFs and international funds, because they are again classified as non-debt and non-equity, non-Indian equity, they will also be eligible for long-term capital gains benefit after 2 years. So today, if somebody has to create a portfolio of, let's say, some allocation to international equity, some allocation to gold, some allocation to Indian equity, and to debt, it is much simpler to do that without worrying about the detrimental tax effect. So actually, net, it is pretty good. The only challenge, Sonal, there is that the international funds, we still don't have limits. Although I think there are some funds which do accept allocations through SIPs. So one can still build a portfolio there. So those are some of the changes. Hope they're clear.
They absolutely are, Ashish. Thank you so much for explaining that in that detail. Mahendra, while we've been talking about all these tax changes, the holding period changes, one of the categories that is gaining a lot of traction is REITs. The holding period for long-term capital gains is reduced here from 36 to 12 months. And with the property tax changes as well, do you think this category becomes very attractive? Is this something that fund managers are looking at?
Yes, I think most people are now looking at it very seriously because this is again going to be the next segment of explosive growth, because the Indians' love for gold and property is known to everyone, and there are a lot of challenges in investing in the real estate sector, and the RERA across India has addressed number of those issues. So real estate market has become very, very well streamlined now to a large extent. So the remaining challenge in the real estate market for a retail investor is the large ticket size. So today the equity investment has been absolutely brought down to incremental of maybe 500 rupees, and people, retail investors in remote villages are also participating in the wealth creation. Same, I think, is going to be replicated on the REIT side, because there are two handicaps of investing in real estate for the retail investor. One I already mentioned is the large ticket size. And the second is the ability to do the due diligence of buying the property. So when it comes in the REITs form, there are experts and professionals who do the due diligence in terms of the legality of the documents of possession and of the construction quality and so on. So therefore, the retail investor can invest in real estate with the confidence that he's getting into the right property at right valuation. And then the third aspect of real estate is obviously the ongoing facility management, which again in this format is done by. So REITs are very popular in overseas markets, and I believe that the good platform has been led by bringing in parity with the taxation of the real estate for that segment to now catch up on the growth.
Okay, all right. That's very helpful, Mahendra. Ashish, I would have liked your views as well. We just have 30 seconds left. If you can quickly tell us your views on REITs in general.
I think positive, Sonal, because again, as I said, it's very easy now for an asset allocator to diversify a client portfolio across asset classes, and REITs will become a mainstay in customer portfolios, and it'll give investors a good way to participate in commercial real estate specifically with some yield benefit in their hands. And now it's 12 months, so it's much simpler to rebalance as well.
And now we're talking about maybe a regime where interest rates will go down. So let's see how this category behaves as well. But Mahendra and Ashish, it was such a pleasure to have both of you on the show today to demystify the changes that we saw in the budget with respect to mutual funds. So many amendments. So we need experts like you to break it down for us as well. Thanks a lot for tuning in. But with that, we'll take your leave on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.